Welcome to everyone, and thank you for joining us today. I'm Camille Matson, the Gift Planning and Donor Relations Manager with Sonoma Land Trust. We'll be recording this webinar so that we can share it in the future, and I'm super excited to be here with our partners at Willow Creek Wealth Management. They generously offered to share their expertise with our community and to answer questions about the intricacies of some giving instruments that can be beneficial for donors like you. And with that, I want to introduce our presenter today, Jake Weber, a wealth manager at Willow Creek, who is also affiliated with the Redwood Empire Estate Planning Council. Jake can tell us a little bit about Willow Creek before I start our interview.
Thanks, Camille. So I am a financial planner, a senior wealth advisor here with Willow Creek. We are a wealth management firm based in Sebastopol, where we've been for 40 years. One of the things that we're really passionate about here is being involved in our community and a lot of the different organizations like Sonoma Land Trust that we've partnered with, and giving back in any way that we can. So I'm happy to be here and support Sonoma Land Trust giving initiative.
Before we dive into some specific tax smart strategies, can you help our donors understand what planned giving really means and why it's become such an important part of philanthropic planning?
Yeah, so planned giving, as the name suggests, is giving in a way that is structured and thoughtfully integrated into a person's financial plan or estate plan. It often includes giving cash gifts, but also non-cash gifts, such as appreciated stock, real estate, things like that. So the point of planned giving is really to maximize the impact of the donation to the organization that you're giving to, but also give yourself some benefit and structure it in a way that is most beneficial to your situation, whether that's from a tax perspective or just from a cash flow perspective when it makes sense to give.
What are some common misconceptions you hear from clients about planned giving, and how do you address their concerns?
I think the biggest misconception or concern that we hear constantly is that you need to be super wealthy to come up with one of these strategies and implement, some of these tools. It's not the case at all. The entire point of planned giving is to be able to support causes that you care about without sacrificing your own financial security. Every contribution, big or small, makes a big difference to these organizations. So, while there are some strategies that might be more complex and not fit for every single person based on their level of wealth, there is a tool out there for everyone in order to support causes they care about.
Someone who's just starting to consider planned giving options, what factors should they evaluate when choosing between different strategies, and what questions should they be asking themselves?
Yeah, so I guess the first question that I would always be asking is what organizations or causes deeply resonate with you. You're giving and you're getting some sort of benefit, from a tax perspective or what have you, but what do you want these organizations to accomplish with these gifts? And so, you want to be committed to that vision. So that's kind of the first thing, is identify where you want to give. And then, the questions about strategy and how to give really center around understanding your own financial picture. Whether that's in retirement or you're gifting while you're still working, what is your income? What assets do you have that are available to gift from? What is your anticipated needs over time? If you have, big expenses upcoming, how should you look at that in relation to your giving plans? Then the other considerations become a little bit more specific, maybe ones that you would explore with a financial planner or a CPA. Tax considerations. Is there a strategy to reduce income in certain years or estate taxes? And then, are you looking to make an impact throughout your life, or leave a legacy after? There's a number of questions, and I think starting with the basics and then bringing in. Yeah, so I guess the first question that I would always be asking is, what organizations or causes deeply resonate with you? You're giving, and you're a team to help you kind of drill down on that is important.
Great. Could you walk us through some of the key advantages and potential drawbacks of the most common planned giving vehicles, perhaps comparing donor advised funds, charitable remainder trusts, and direct charitable gifts?
Yeah, so among those three, I think everyone's pretty familiar with what a direct gift is: writing a check or just giving cash or funds to an organization. That's going to be the most straightforward, immediate gift. It's going to require the least amount of planning on your end as the donor. But there are some drawbacks that a charitable remainder trust or a donor advised fund may offer above that. So a charitable remainder trust is, think of it like a bucket that you're putting money in, or you're putting stock in, or you're putting assets in, and throughout the term of the charitable remainder trust, you get back some level of income. These can be a little bit more complex to set up than donor advised funds or obviously direct gifts. But depending on what your income needs are, kind of like what we talked about with that last question, it can really help support you for the long term. So that is a tool that is out there that is helpful for a lot of people, but might be a little bit more complex. Donor advised funds are kind of this middle ground, I would say, where you put money or assets into a donor advised fund, you get the tax write-off right away, but you have flexibility over when to distribute those funds or assets to charitable organizations. So you still retain some control over the assets in terms of being able to choose the investments and things like that, or when to have the biggest impact on the organization you're donating to. But you don't actually have the ability to pull any assets back or have any income stream like a charitable remainder trust.
Awesome, that's helpful. So more and more people are giving through donor advised funds. They're becoming quite popular. How do they work, and what makes them particularly attractive for donors who want flexibility?
Yeah, so like I mentioned, when you put the money into a donor advised fund, you get the tax write-off right away for the full market value of whatever went in there. So one of the nice things with this is, let's say you, I don't know, are selling a rental property and you have a large capital gain in a certain year. You can go ahead and put money into the donor advised fund to help offset that gain all in one year, but you don't necessarily have to know where you want that money to go in terms of charities, and you can make that decision over time. So there's a lot more flexibility, and it can be very helpful when timing is important in terms of maximizing your own tax benefit. They give you generally kind of an easier way to keep records as well. When you donate to 10 different charities, let's say, keeping receipts for all those can be a little bit more cumbersome. When you donate it to a donor advised fund and then send it to 10 charities, it's just one receipt for that initial deduction of what went in there. So the record keeping is a little bit easier, but it's important to note, just like a direct gift, the gifts are irrevocable. When you put money into a donor advised fund, they can't be reclaimed. You are not the legal owner of the assets anymore. So just important to understand that once it goes in there, it's not coming back.
So, a few folks have asked me about charitable remainder trusts, and they sound pretty complex. Can you explain in simple terms how they work and what type of a donor situation makes them worth considering?
Yeah, so let's back up to the donor advised fund. And think of it kind of in the same way, an account that all the money goes into or assets go into, you get the tax deduction. But the difference with the charitable remainder trust is assets that are contained within that trust, you still get some level of income coming out. That's determined when you actually set up the trust based on what you're going to be putting in there. Because of that income draw, there is a little bit more complexity in figuring out what you are actually getting the deduction for. It's generally not the full market value because money is going to come out and come back to you. So that does have to be determined. But they make a lot of sense for donors who need additional income. They want to make a big donation, but they need to have income to support their lifestyle, frankly. So once the term of the charitable remainder trust is up, all the assets in there go to the end charity, but while they're contained in there, you just get the income off of the investments. So like I said, they're a little bit more complex when you go through the setup process. But for donors that want to make a large donation, but don't want to lose the income coming off of the investments, they're a great tool there.
Awesome. Many of our supporters have started giving us appreciated assets, whether it's stock, real estate, or other property. And lots of them are giving it directly because it's beneficial for them. And could you explain what should donors know about gifting assets directly versus selling them first?
Yes. So this is a key point for any planned giving strategy, that appreciated assets, when you sell them as the donor or the owner first, you're going to pay taxes on any of the gains from the stock or real estate. That's just the fact of it, unfortunately. If you give it to a charitable organization up front without selling it first, you're going to get the full write-off for the market value of it. When the charity goes to sell them, they're not going to pay the taxes on the capital gains. They're a tax-exempt organization. So one, for your own simplicity's sake, it's a lot easier just to donate rather than dealing with the sale and then the taxes and then the end gift. But also, you get to donate more and the organization gets to receive more. So I would definitely recommend prioritizing, when making a charitable gift, assets that have a low basis or have gained a lot and appreciated a lot over the years.
That makes sense. For donors who are thinking about including Sonoma Land Trust in their estate plans through their will, what are the key considerations and potential tax benefits they should discuss with their estate planning attorney?
Yeah, so I would say the key for coming up with sort of a legacy gift is identifying what they want that gift to ultimately do. And also, from a tax perspective, is there a tax reason to do so? The estate tax threshold where you would pay any estate taxes is very high at this point. We're talking, 24 million as of the last tax bill. So if your estate is lower than that, you're not really getting a tax benefit by including that in your trust or will. So there may be an opportunity to reduce taxes throughout your life and see some of those gifts result in some of the causes or some of the things that you want it to, if you're gifting throughout your life rather than doing it all in a will or estate plan. That's kind of the bookend of planned giving, is putting things in your estate plan and your will. But discuss with your estate planning attorney if there are benefits to you donating some of this throughout your life, or if it makes most sense just to have it all at the end in your will. For a lot of people, again, you don't pay estate taxes unless your estate is over roughly 24 million. So might as well get the tax benefit and see the fruits of the donation while you're here with us.
That makes sense. Donors can make qualified charitable distributions directly from their IRA.
Yeah.
Can you explain how this strategy works and who might benefit from it? And I think there's a specific age when donors can start doing that. Is that right?
The age is 70 and a half. I know it's kind of a weird a weird age to have it at rather than a round number, but it's 70 and a half. The idea is that when you take money out of your IRA, it's taxable as income to you. However, if you have it go directly to a charity and you specify when it comes out, this is what's called a qualified charitable distribution, a QCD, and not going into your name or your bank account, that income never goes on your tax return. You never get a form generated that shows that additional income coming out of your IRA. The benefit here is, in order to go ahead and claim a charitable deduction on your taxes, you typically have to itemize. And with the standard deduction being as high as it is, most people do take the standard deduction. So with the QCD, you're basically getting a tax break by that income not being included, rather than getting a write-off on your taxes. So it's definitely a powerful tool, especially if you don't need the income from your IRA or those required distributions that you do have to take. I would definitely be looking at this. If you don't have a lot of tax write-offs and you're not itemizing, this would be one of the most efficient ways to give.
That makes sense. So even if you're giving a cash gift, but you're taking distributions from your IRA, you should switch to making a QCD. That would be more beneficial.
Oh, absolutely.
Making a
Yeah.
straight gift.
If you're writing a check every year and you're taking distributions from your IRA, it's probably, and I would say probably, because there's a possibility that you do itemize and still get that deduction, but more than likely it makes more sense just to have it go direct from your IRA to the charity.
As we wrap up, you've mentioned several times the importance of working with professionals. Could you emphasize for the audience what types of experts they should consult and what questions they should ask when they're exploring strategies for their specific situation?
Yeah. So I guess the types of experts, I'm a financial planner. This is kind of what we do. This is well within our wheelhouse. So obviously I recommend financial planners to kind of get the conversation started. Your financial planner should be well aware of not only your tax situation, your estate plan situation, and be able to bring in additional experts should your situation call for it. They should be asking or letting your financial planner know that they do want to explore charitable giving and find ways to make it more beneficial for themselves and the charities that they're donating to. I think a lot of people, might not consider that, even writing a check $1,000, $2,000 a year is something your financial planner should know about, and you should express the the desire to come up with a plan for this. I think some people might not realize that this is something that we do. I would also obviously talk with your accountant or CPA, as you're implementing these strategies, and make sure they're aware of it if there's some tax planning that they need to do around it. And obviously, you should include your estate planner in it. If you're changing things with your gifting goals, if you're shifting some of the bequests that you have in your will or your trust and doing some of them throughout your life, consult them as well and let them know kind of things are changing.
That makes sense. Um, those are all of my questions today, Jake, but I know we have some from the audience. And
Great.
so I think, one thing that we hear a lot is folks who want to get their children involved and their family involved in their philanthropic planning. And um, what are some ways that, or why is it important to involve your family first? And then how can you use some strategies to get other folks in the family involved?
Yeah, well, first of all, I think it's just important in general to involve younger generations and things that you care about and letting them know that you care about it. Just for the reason of, let's say you have something in your will that's going to a charitable organization, they're able to understand your goals for that donation. If it's not spelled out incredibly clear in the will, they're able to make sure that that happens. And also, if it's something that you care about and you're willing to donate to this organization, it's probably something that's pretty important to your own ethos and your life, and involving family and getting them to share in that cause is just a great thing to do with family. I'm sorry, what was the second part of the question there? I kind of went on a tangent.
No, that was great. I think the question is that, if there are any strategies to help jumpstart that conversation.
Yeah, so I would say the strategy, I mean, this is just general financial strategy as well, is make sure your kids and your family understand the things that are important to you. Make sure that they have a copy of your will or your estate plan in case something were to happen. Talk to them about these things and get them involved. That doesn't have to be directly for, a charitable organization either. Just including your family on your intentions for your finances just ensures that you're going to be able to implement the things that you want to do throughout retirement and through your life. So I would say, in terms of tools, we were talking about charitable remainder trusts and donor advised funds and all that kind of stuff. They're not really something that I would say you need to put them on as a joint holder or anything like that, but let them know you have them, let them know that this is something that you're doing and that it's important to you.
We have a really amazing supporter who talks about intergenerational communication, and she once told me that the best way to start those conversations is to ask what they're interested in. Whoever is involved in your estate to get on the same page, like what your goals are for your financial health for, retirement and things like that, and what their goals are, and, what you care about, and ask them what they care about. And that really is helpful to get everybody on the same page. And I would say the same with Sonoma Land Trust, because if you want to make a charitable gift with your estate, explain to the people in your family that you care about why that's so important to you, and just establishing that. And then also letting us know at Sonoma Land Trust is so important, because, we want to be able to steward your wishes and make sure that our plans and goals are aligned with what what donors are interested in seeing happen in the future. So,
Two, for charitable organizations, knowing, you know, uh, being able to plan for whatever your gift giving plan looks like is very helpful to maximize where that money goes. Surprises are great, but being able to plan for those influxes of donations is very important for those organizations.
right, absolutely. Okay, here's an easy one. Can a 401k be used in a qualified charitable distribution?
So unfortunately, they cannot. Um, it is right now only in IRA accounts. I don't really see that changing, unfortunately. Um, with a 401k, you can always roll over the 401k into an IRA, especially if you're no longer working with the company that sponsored the 401k, and then do a qualified charitable deduction from there. But unfortunately, yeah, no, not 401ks.
Okay, can you give only part of your RMD from your IRA? Like, say you have $10,000 required minimum deduction, and you give 5K to charity and 5K for yourself.
Absolutely. Yeah, you can do 5K to a charity, 5K to yourself. You can do 5 individual $1,000 donations to 5 different charities and keep 5,000 for yourself. The only thing I will emphasize on this is make sure that the money, when it comes out, is tagged as a qualified charitable distribution. If it goes into your name, if it goes into your bank account or a brokerage account in your name or something like that, it can no longer be used for that QCD purpose. So contact, whoever is managing your IRA. If you're doing it yourself through like a Schwab or something, give them a call. Whoever your broker is, make sure that they understand your intent, because the check, when it comes out, has to be made out to that charitable organization. It cannot be made out in your name.
Good to know. That's a great tip. And I think this is a good place for me to plug our new Tax Smart Giving section on our website. That's at sonomalandtrust.org/tax smart. And that is a great place that you can fill out a form to give appreciated stock through qualified charitable distribution that goes to your financial institution, and then also through your donor advised fund. So easy, really easy ways to go straight to our website and make those tax smart gifts at sonomalandtrust.org. Okay. If one has to pay estate taxes upon your death, how can one reduce this tax burden with charitable giving?
Yeah, so any bequests or legacy gifts that are coming out of your trust or your IRA or whatever, do not count as part of your taxable estate for estate planning purposes. So I don't know, let's say the limit was 24 million and you have 28 million. If you gifted 4 million in your will or your trust, you would pay no estate taxes. So that is one nice benefit of including bequest in your estate planning. However, I would still encourage, you might as well do some of that gifting throughout your life if you can. That will also reduce the amount in your taxable estate for estate tax purposes.
Right. And are there some assets or accounts that are more taxable than others when they're transferred to a beneficiary?
So retirement accounts are always going to remain retirement accounts. When a beneficiary gets them, they're going to be converted into inherited IRAs or things like that. But retirement account, someone is going to pay the taxes unless it is a charitable organization. So that could be a big planning goal or planning topic with your estate planner or financial planner. If you're going to leave a bequest, you could leave your IRA as, name the beneficiary of your IRA as a qualified charitable organization. And that way your beneficiaries don't have to pay the taxes on it.
Okay, here's another question. I have an investment advisor and a lawyer for my trust. Talk about the services you would provide that might be similar or different. Should I also have a financial planner?
Yeah, so investment advisor is kind of a loose term, I guess. Some investment advisors are also financial planners. it's the terms aren't well defined, I guess. So I don't know what kind of scope that your investment advisor operates. Maybe they do financial planning, and this is something in their wheelhouse. But if not, I would recommend reaching out to financial planners. There are financial planners that work with assets under management and do the investment management as well. There are others that are hourly and will put together a plan and walk through these strategies with you without needing to change the investments. So there are a lot of different options out there, but I would say that this, a lawyer might be able to help you with some of this, or a CPA might be able to help you with some of this, but really this is probably more in the financial planning lane, other than those two aspects of it.
Great. So if someone is gifting property with their estate, is it feasible to have the executor sell the land and donate the money from the estate rather than have the charitable organization go through the process of sale?
Um, I it's up to you, I guess. I would say that, generally the executor, the executrix is someone who maybe isn't super involved or wasn't involved with that land or real estate throughout their life, maybe. And it can be kind of a pain to, get it ready for sale, hire, a real estate agent and go through that process. There's not really, I don't know, there's not a whole lot of difference from a tax perspective if you were to sell it first and then or donate it before selling it. But I would think it's probably more of a hassle for the executor to go ahead and put it on, put it on the market and do that. I
Yeah.
would reach out to the organization that you want to donate it to and see what
Yeah,
they would prefer.
100%.
Um,
Yeah, I think it's a great the charity that you want to leave the property to, so you can make sure, that it's mutually beneficial and that everyone's agreed on the process. And I can say at Sonoma Land Trust, we've done it both ways. And then also, if you have an executor or an executrix who's a family member, for example, you can also put into your plan that you would like a licensed fiduciary to deal with that process to kind of take that off of their shoulders and that kind and or you can even name a licensed fiduciary as your executor to take on those kinds of more complicated and time-consuming tasks that have to do with your estate. Oh, here's one that's back to IRA, and QCD gifts. How is the required minimum distribution calculated?
So it's just a factor of what the account value was on December 31st of the previous year and what they call the uniform life expectancy table, which is basically generally 97, 98. How many years until you turn 97, 98? And then you take the previous year's value, divide it by that, and that's where they get it. So the required distribution is going to fluctuate year to year based on the account value, but generally it's just the IRS wants those to get distributed at some point, so they get their tax money.
Right. I think that was, here's one that's kind of about Sonoma Land Trust. So it's about whether you can, um, you know, um, restrict your contribution to a particular project. And I would say, certainly if you're making your gift now within your lifetime, that's something that we could discuss, what kind of project or current initiative that you'd like your donation to go to. And as far as the future, again, another conversation we would love to have. We do have specific funds that those can go to, for example, for acquisition of new property and things like that. So just a great reason to reach out to me or one of my colleagues at Sonoma Land Trust. Um, Thank you so much, Jake, for all this amazing
Yeah.
and all the time that you spent preparing for this. And also a huge thank you to Willow Creek Wealth Management. And thanks for all the great questions from our audience. Before we close, you may have heard that August is Make a Will Month, and in that spirit, I want to thank those of you who have already taken the step to become members of our Legacy League for your generosity. For those of you who aren't members, the Legacy League is made up of supporters who have committed a future gift to Sonoma Land Trust in their will or trust or through a beneficiary designation. This amazing group of conservation-minded folks contains some of our most loyal donors, and for many of them, their legacy gift is their most generous gift of their lifetime. And we really want to honor that while you're still here with us. So we'd love for you to reach out now to let us know and discuss your gift and your plans with us. Um, so that we can align our work with your vision for your gift, and also so that we can thank you. And when you become a Legacy League member, you'll receive benefits like joining our annual event for the Legacy League, special mailings and publications, as well as invitations to on the land outings. And if you have an existing legacy gift, please let us know. It's the perfect time because of our legacy match, thanks to the generosity of our donors, Diane Brinson and Mark Radcliffe, who will give a $1,000 cash gift for each new Legacy League member before the end of 2025. And finally, I mentioned already, Sonoma Land Trust recently updated our website to make it even easier for you to give through appreciated stock, QCD, and through your donor advised fund. And you can visit our website at sonomalandtrust.org/taxsmart or reach out to me directly. My email is camille@sonomalandtrust.org. Thank you so much for joining us today. If you want to talk with Sonoma Land Trust about your planned giving, please reach out to me. And if you'd like to learn more about our projects on the coast, please let me know or reach out to a member of our philanthropy team. And if you'd like to make a tax smart gift, again, the webpage is sonomalandtrust.org/taxsmart. Thank you so much for joining us today. We're so grateful to you for your support of our work and of the land. Have a great day.